Hello, guys. Welcome to another episode of Everything Business. Welcome to part two of the Petty Cash Book lesson. If it is your first time, please subscribe, like, and share. And if it is not your first time, thank you for visiting. Thank you for coming back. And I hope that this lesson will be informative for you. All right. So in this tutorial, I'll be doing a past paper question, right, as was promised in part one, right? And if you have not seen part one of this video, then you can look in the description below, and you will see the link, right, for the part one of this video. All right. You can also check in the description below for the channels or the tabs, right, or the chapters rather, right, and you can just skip and go through the chapters as you see fit. All right, so let's get right into it. All right, so we're going to be looking at a past paper question from 2003. All right, and let's look at what the question is saying. So it says Olga Lewis keeps her petty cash on the imprest system. Her imprest amount for the month of June 2001 is $600. So right off the bat, we identify that $600 is the amount that is the float. Very good. I remember that we spoke about the float in part one, that the float, is like a boat floating on the sea, right? It is always remaining constant, it is to be kept at that one figure, right? So he says our petty cash transactions were as follows. All right, so in 2001, and they gave us the list of transactions there. It says on the form provided. All right, so you'll be provided with a form, so you don't need to worry about drawing about this long petty cash, right? They'll provide you with the form, right? It says you are required to 1. Restore the imprest amount at June 1. Then 2. Enter the petty cash transactions in the petty cash book. Then 3. Balance the petty cash book for the month of June. And then 4. Reimburse the petty cash with the imprest amount. And then this is 12 marks. This is 12 easy marks. All right, so let's get right into it. I find this question rather interesting. How they decided to start off the question. So they decided to start off the question by providing you with the closing balance on the petty cash book, right, which is $18. And if $18 is the closing balance, then it would be the opening balance. All right, and so we will record it as the opening balance, right? So you go there now in your date column. Hope you can see my pointer. You write June 1 balance brought forward, and in the receipts column, right, on the debit side, you would have $18. All right, good. And then it says the next item says petty cash restored to the imprest. So they are asking us to restore the imprest amount. Remember, under the imprest system, we will pay the petty cashier the amount of money that was spent. Now, if we know that the float is $600, right, and the petty cashier has $18 remaining from that $600, then all we need to do is to subtract the $18 from the $600, which is the float, to get the amount of money that the petty cashier actually spent in the month of May, right? And so we did that, and we get what? $582. So $582 is the amount that we now need to reimburse the petty cashier with, right, at the 1st of June. So here you go. On the 1st of June, right, we gave cash to the petty cashier, and in the folder column we would have CB, which would stand for cash book. Very good. And in the receipts column we would have $582. All right, so now we have restored the imprest amount to the petty cashier, and now the amount of money that the petty cashier has to spend for the month of June is $600. So the float has been restored. Yes, here we go. So the next transaction, June 4, stamps bought. All right, now when we are recording in the petty cash book, when we are recording expenditures rather in the petty cash book, we write the date, we write the details, we write the voucher number, right? And it is important to note that we record the amount of money for the transaction or the expenditure in the totals column, but we should also record the amount, right, under the expenditure column or the analysis column. So because we are buying postage stamps, right, we have an analysis, right, tongue twister. We have an analysis column for postage, right? And so we would record stamps being bought under this analysis column. All right, very good. So you record it under the totals column as well as the analysis column. It is very important that you remember that. There are times when you may be tempted to only record the information under the totals column. All right, but that would be an error in principle. All right, so continuing, June 7, bought stationery, right, for $36. Again, you record it, the information, the date, the details, stationery, the voucher number, record the information under the totals column, and also you record the information, the same amount, under stationery. And then we move on to June 8th, right, janitor's wages. We pay janitor's wages, right? So we record the information, the date, the details, the voucher number, record the amount under the totals column, and also under the analysis column for janitor's wages. The next transaction, we bought stamps, and it is very similar to June 14, very similar to June 4. All right. June 18 also is very similar to June 7. I want you to look at that. See the similarity? So the same principle would be followed there, right? June 19 again is very similar to June 8. So the same principle would apply right there. June 29, it says taxi fare for $48, right? Now I want to introduce you to this column here, the sundry expenses column. Now sundry expenses are small expenses, right, that they are so small that what is done is that they are grouped together, right? So the small expenses can range. So taxi fare is an example of a sundry expense, right? And so June 29, taxi fare in the details column. In the totals column, the amount is 48, and you put the 48 under the sundry expenses column. All right. Then we have again on June 29, so stationery, which is very similar to June 18. So the same principle would apply there. Then you have June 30, which is another example of a sundry expense, and so the same principle would apply there. June 30, electricity, another example of a sundry expense. In this case, because we do not have an analysis column that it could fit under, right? And so you record it under the sundry expense column. June 30, telephone, which is another example of a sundry expense, all right, sundry expenditure. So the same principle would follow there or apply there, all right. And then we have completed entering our items. Now we are going to total all the analysis columns, total all of them. So you add them up, come down in a line, add them up, add them up, add them up. Every column, from the totals column, go straight back. All the analysis column, we're going to add them. Now I want you to realize that the analysis columns, right, the amount, the totals have a line underneath it, right? Now that line would signify that we are not going to use these columns again. So we are finished with these columns for the month of June. All right. However, the totals column, I want you to realize that the totals column does not have a line underneath it, or the totals amount rather does not have a line, which is the $591. It signifies that we are going to use this figure again. All right. So that is the first step in balancing off the petty cash book, right? And some persons find it a bit tricky to balance off the petty cash book, but don't worry yourself. You guys are good. You guys are bright guys. All right. And it is very simple to do. All right. Anyhow. So that's the first step, to total each column. Then the next step, right, is to calculate the balance carried down on the petty cash book. And how do we do that, right? So we say the 591 minus from the float, which is $600, which would leave a balance of $9. So you're given $600, you spend $591 out of that $600, then the balance is going to be $9 on the account. All right, and so we insert the balance carried down, right? And now both sides are equal. So 600 on that side, the credit side is 600. All right, pretty much similar to when we are balancing off the cash book, right? Our double entry account. Yeah. All right, very good. All right. So now both sides are equal, and if we have a balance carried down, of $9, then we must have a balance brought down for the beginning of the next month, right? And it must be brought down below the totals. So here we go. July 1, balance brought down, BD, is $9. So we are starting July now with $9 in the petty cash account. All right, and then the last part of the question says we should restore the impressed amount. And so if we spent $591, then how much money should we receive from the senior cashier in order to restore the float of $600? Very good. The amount of money that was spent, $591, you would put that money there because that is the amount of money that was spent, and so the senior cashier needs to give you back that $591 in order to restore the float. All right, so there you have it. Past paper question. It really doesn't get much more difficult than this, I can tell you that. All right, so remember to always keep practicing, practice, and that is how you do well in accounts. So let's review. All right, so the petty cash book is a book of original entry used to record small or petty transaction or expenditure. Before recording in the petty cash book, a petty cash voucher must be filled out. All right, the petty cash book operates using the Impress system, right? And the Impress system states that the petty cashier be given a sum of money from which to make petty payments, and this sum of money is called a float. Yeah, float. And whatever money is spent by the petty cashier during a period must be given back to the petty cashier in order to maintain the float. All right, so thank you for viewing. Please remember to like, subscribe, and share. If you have any comments, comment in the comments section below, right? And shoot me an email, right? And Everything Business is now on Instagram, so you can check that out as well. All right, thank you for viewing. Well, good.